In most states, a driver with a perfect driving record and poor credit pays more for car insurance than a driver with a DUI conviction and excellent credit. Not slightly more, meaningfully more. That finding comes from a Consumer Federation of America report analyzing insurer rate filings across the country. Your driving record, the thing you assumed was the main factor, is often less important to your insurer than your credit score. Car insurance rates rose 46% from 2022 to 2024, according to Insurify's 2025 Auto Insurance Trends Report. In 2024 alone, the average driver paid $2,543 annually, a 26% increase over the prior year, according to Bankrate. Rates have risen for 7 consecutive years. The average cost of full coverage in 2025 was $2,101 per year, a record high even as the rate of increases slowed. The official explanation focuses on repair costs, climate disasters, and supply chain issues, all real factors. But those explain why rates went up across the board. They don't explain why two drivers in the same city, driving the same car, with the same accident history, can be paying dramatically different premiums. Here's what's actually inside your rate, who benefits from how it's calculated, and the coverage mistakes most people make when they try to cut costs. Car insurance is priced actuarially, meaning your premium is set by predicting the statistical likelihood that you will file a claim and how costly that claim will be. Insurers use dozens of variables to build that prediction. Some are straightforwardly related to driving risk. Many are not. The driving factors you'd expect: your accident history, traffic violations, years of driving experience, and annual mileage. The non-driving factors you may not know about: your credit score, your zip code, your occupation, your level of education, your homeownership status, and in many states, your marital status. These are called non-driving rating factors, and in most states they are legal, commonly used, and largely invisible to policyholders. The credit score effect is the most documented and most consequential. A Consumer Federation of America report found that drivers with poor credit pay, on average, 115% more annually than drivers with excellent credit for identical coverage on identical vehicles. In Michigan, drivers with poor credit pay 263% more. And critically, in most states, insurers consider credit information a more important rating factor than a driver's actual driving record. A perfect driving history does not overcome a low credit score in most pricing models. Your zip code is one of the single most powerful variables in your car insurance rate. Insurers price by zip code because claim frequency and severity vary by geography. More densely populated areas have more accidents, more theft, more uninsured drivers. That logic has actuarial basis. But the implementation produces outcomes that have drawn legal scrutiny in multiple states. A 2026 study commissioned by the Illinois Secretary of State found that a driver in a predominantly Black South suburban zip code paid more than 2.5 times the bodily injury premium of a driver with identical characteristics in a downstate rural zip code. Same driver profile, same coverage, different zip code. An Illinois legislative bill passed the State House in 2026 to require state review of rate increases above 10% for discriminatory pricing. California, Hawaii, Massachusetts, and Michigan have already banned the use of credit scores in auto insurance pricing entirely. The insurance industry's counterargument is statistical. Historical data shows that drivers with poor credit file more claims, and that those claims cost more. The correlation is real. But correlation between a socioeconomic characteristic and claim frequency is not the same as that characteristic causing higher driving risk, and using it in pricing effectively charges people more for circumstances they did not choose and often cannot quickly change. The 46% rate increase from 2022 to 2024 does have legitimate structural causes. Modern vehicles are significantly more expensive to repair. Sensors, cameras, and advanced driver assistance systems mean a minor fender bender that once cost $800 now costs $3,500. Supply chain disruptions drove up both parts, costs, and labor rates. Climate-related losses have accelerated. In 2024, there were 24 separate billion-dollar weather events in the United States: hurricanes, wildfires, flooding, each generating waves of total loss vehicle claims. Insurers recoup those losses through premium increases applied broadly, including to drivers in low-risk areas who had no claims. Used car values surged during the pandemic supply shortage and remained elevated through 2024. When insurers pay out a total loss claim, they pay the vehicle's actual cash value. Higher vehicle values mean higher payouts, which flow back into premiums. Here's the framework. Car insurance is mandatory in 49 states. You are legally required to buy it. That changes the dynamic for most consumer products. You cannot opt out. You cannot go without. The insurer knows this. The state knows this. And the pricing model is constructed within that context. Because it's mandatory, the consequences of getting the wrong policy fall entirely on the buyer. The most common mistake people make is buying minimum liability coverage to lower their premium and discovering when they need the coverage that minimum limits were written decades ago and haven't kept pace with actual repair and medical costs. Many states' minimum property damage liability is $10,000, the repair cost for a moderate collision with a newer vehicle. The second most common mistake is skipping uninsured and underinsured motorist coverage. Approximately 1 in 8 drivers on American roads is uninsured, according to the Insurance Research Council. If an uninsured driver hits you and is at fault, their insurer pays nothing because they have no insurer. Without uninsured motorist coverage on your own policy, the cost of repairs and medical bills comes out of your pocket or requires a lawsuit against someone who likely has no assets to pursue. The single most effective action most people can take on their car insurance right now is shopping their policy. Insurance pricing varies dramatically between carriers for identical coverage. Studies consistently find that the same driver can receive quotes that differ by 50% to 100% for the same policy from different insurers. Most people last shopped their car insurance when they bought their car. That was likely years ago. 3 things to do with your car insurance this week. First, get at least 3 competing quotes for your current coverage level. The Zebra, NerdWallet, and PolicyGenius all aggregate quotes from multiple carriers simultaneously. If you haven't shopped in more than 2 years, there's a high probability you are overpaying. Loyalty to your current insurer is not rewarded. New customers typically receive better rates than long-term ones. Second, check whether your policy includes uninsured and underinsured motorist coverage. If it doesn't, add it. It is inexpensive relative to the protection it provides and addresses the most common scenario where minimum liability insurance fails. Third, look at your liability limits. If your property damage liability cap is at the state minimum, often $10,000 to $25,000, and you cause an accident involving a newer vehicle, the gap between your coverage and the repair bill becomes your personal liability. Your liability coverage should reflect what you could realistically be sued for, not what the state requires as a floor. This video is educational content, not insurance advice. Your specific vehicle, location, driving history, and financial situation all affect what coverage makes sense for you. Next week, how taxes actually work. Specifically, the marginal tax bracket misunderstanding that causes people to turn down raises, and the deductions most people leave on the table every year. Subscribe so you don't miss it. 1 video a week, no filler.